So for the first slide in this video is introduction. Aeon Co. Berhad was established in 1984 as subsidiary of Aeon Company Japan. It is 51.7 owned by its parent company and aims to modernize the retail industry in Malaysia. Aeon operates a wide network of outlets including Aeon Malls, Aeon Store, Aeon Max Value Supermarkets, Aeon Wellness Pharmacy and Daiso Specialty Store. These outlets serve millions of customers each by year, providing products like daily essential, fashion, home goods and electronics. Aeon also support local businesses by collaborating with SME, offering retail space and fostering business growth. Over time, it has earned a reputation for quality, innovation and sustainability. For the business model, Aeon business model has three main pillars: retail, property management and digital commerce. In retail, Aeon operates various stores offering products like groceries, ready-to-eat meals, clothing and beauty items. In property management, Aeon manages shopping malls that combine retail, dining and entertainment, creating vibrant community hubs. In digital commerce, Aeon runs the My Aeon To Go platform for online shopping with option for delivery or store pickup. They also partner with Foodpanda to provide additional convenience. So for the core value, Aeon operations are guided by 4 values: empathy, compassion, integrity and kindness. Empathy, listening to customer needs; compassion, caring for the community and employees; and integrity, acting with honesty and transparency; and also lastly, kindness, creating positive impact through meaningful action. So lastly, for the market position, Aeon is one of Malaysia's top retail operator with 178 outlets across the country. Its malls act as community hubs, combining shopping, dining and entertainment. Aeon digital platform like My Aeon To Go and partnership with Foodpanda extend its reach and make shopping more convenient. With its focus on sustainability, innovation and customer satisfaction, Aeon continues to lead the retail market in Malaysia. So for the next slide is the importance of ratio analysis in the business. So the first point is financial performance analysis. Ratio like profit margin and ROI show how much profit a company earns from sale and investment, helping to measure financial success and growth. The second is decision making tool. Ratio like debt to equity and inventory turnover guide managers in making smarter decisions about borrowing, spending and resource management. Third, strategic planning. Metrics like ROI and profit margin help plan growth strategies and allocate resources effectively for long-term success. And lastly, managing risks. Ratio, they identify risks early, such as high debt to equity ratio, signaling over-reliance on borrowing, allowing business to fix the issue proactively. So for the next slide is, I will discuss the financial performance of Aeon for 2020 and 2023 by analyzing key financial ratio. These include liquidity, debt and asset management, also profitability ratio. Each ratio provides valuable insight into Aeon financial health and operation efficiency. First, let's look at the liquidity ratio, which assesses Aeon's ability to meet short-term obligation. Current ratio in 2020, the ratio was 0.5 times, improving slightly to 0.51 in 2023. This value indicates that Aeon has less than 1 ringgit in asset for every ringgit of liability, suggesting potential challenge in meeting short-term debts despite slight improvement. Quick ratio, this include inventory focus on more liquid asset. It dropped from 0.17 in 2022 to 0.14 in 2023, highlighting a growing dependency on inventory to cover liabilities, which is cornering. Now, moving to debt ratio. Aeon debt ratio decreased from 66.07% in 2020 to 64.4% in 2023. While this reduction reflects reduced reliance on debt, the ratio remained high, indicating significant financial leverage and potential risk if revenue decline.
So here we go to the time interest earn ratio shows how well Aeon can pay its interest expenses using its operating income. In 2022 and 2023, the time interest earn ratio was 2.84. This means Aeon earns about 3 times the income needed to cover its interest payments, while Aeon is able to meet its interest obligation. This ratio doesn't leave much room for challenges. If Aeon's earning drop because of market conditions or higher costs, it could face difficulties paying its debts. The time interest earn ratio highlights that Aeon should maintain steady earnings and keep an eye on costs to avoid financial risk. Improving this ratio by lowering interest expenses or increasing earnings would make Aeon's position more secure. Next, let's look at Aeon's asset management ratios, which is measure how efficiently the company uses its resources. The first one is inventory turnover ratio. This ratio increased from 6.84 in 2022 and 7.13 in 2023. It shows that Aeon is selling and replacing its inventory faster. This is a positive sign as it reduces storage costs and the risk of unsold items becoming outdated. Second, total asset turnover. This ratio improved slightly, going from 0.76 in 2022 to 0.79 in 2023. It shows Aeon is using its assets better to generate revenue. A higher ratio means the company is making more sales with its resources, which is a good indicator of efficiency. Third, average collection period. The collection period increased from 6.8 days in 2022 to 7.9 days in 2023. While this is still a short time, the increase shows that Aeon is taking longer to collect payments from its customers. If this trend continues, it could affect cash flow, which is important for paying bills and funding operations. Overall, Aeon has improved in managing inventory and using its asset, but it needs to work on collecting payments faster to avoid cash flow problems. Next, profitability ratios are important because they show how much profit Aeon is making from its sales and resources. Operating profit margin. This margin increased from 7.9% in 2022 to 8.2% in 2023. It means Aeon is earning more profit from its main business after covering its operating costs. This is a good sign of improved cost management and efficiency. Net profit margin. This margin also increased slightly from 2.7% to 2.8%. Although the change is small, it shows Aeon is managing overall costs better and keeping more of its revenue as profit. Return on assets, ROA, went up from 2.1% to 2.2%. This shows Aeon is using its assets more effectively to make a profit. A higher return on assets means the company is doing a better job of making money from its resources. Return on equity slightly from 6.15% in 2022 to 6.17 in 2023. This means Aeon is maintaining steady returns for its shareholders, showing that the company can generate consistent value for investors.
Next, we go to the second task, which is we want to compare Aeon company with industry average. First of all, the current ratio measures a company's ability to make short-term obligation using its current asset. Aeon company Berhad's current ratio stands at 0.51, significantly lower than the industry benchmark of 1.58. This indicates that for every RM1 of liability, Aeon only has RM0.51 in current assets to cover it. Such a low ratio suggests potential liquidity challenge as the company may struggle to pay its short-term debts, especially during financial strain. Improving this ratio is crucial to building creditor confidence and ensuring the company can manage its immediate financial responsibilities. Second is quick ratio. The quick ratio, also known as the asset test ratio, evaluates a company's ability to meet short-term obligation without relying on inventory. Aeon Company Berhad's quick ratio is 0.14, which is well below the industry average of 1.0. This means Aeon heavily depends on its inventory to meet its financial needs, which is risky because inventory is less liquid and may not be easily converted to cash in emergencies. This low ratio highlights the company's vulnerability to liquidity challenge, and improving it would enhance its financial stability in the eyes of investors and creditors. Third is the inventory turnover ratio. It measures how efficiently a company sells and replenishes its inventory. Aeon Company Berhad's inventory turnover ratio is 7.13, slightly higher than the industry average of 0.1. This indicates that Aeon is efficient in managing its inventory by restocking frequently and converting it into sales at a good pace. However, while this is a positive indicator of operational efficiency, the company must balance frequent restocking with cost management to ensure profitability. Overall, this ratio reflects Aeon's ability to maintain agility in inventory operation.
For debt ratio in competitive analysis, in 2023, Aeon Company Berhad report a debt ratio of 64.41%, lower than the industry average of 75.3%. This indicates reduced reliance on debt financing, which is lowers financial risk. Approximately 65% of Aeon's assets are financed through debt, with the remainder supported by shareholder equity. A lower debt ratio is generally favorable as it reduces the potential of financial loss, positioning Aeon as a financially stable company compared to its peers. For net profit margin, Aeon Company report a net profit margin of 2.78%, significantly lower than the industry average of 6.16%. This lower profitability is likely due to high operating expenses, interest, taxes, dividend payment, and other costs. This factor reduce Aeon's ability to achieve competitive profit margins, highlighting the need of efficiency improvement. Last, for competitive analysis, which is return on equity. In 2023, Aeon Company Malaysia Berhad record a return on equity, which is ROE, of 6.18%, exceeding the industry of average, which is 5.25%. This indicates Aeon provide better return to its shareholder compared to its peers. The ROE reflects the company's ability to generate profit from common equity, showcasing effective utilization of shareholder investment to drive profitability.
Now we go to the strength of the Aeon Company. Aeon Company Berhad has several notable strengths. First, its prudent debt management is a standout feature, with a debt ratio of 94.4%, significantly lower than the industry average of 75.3%. This conservative approach reduces financial risk, ensuring stability during economic uncertainties and making Aeon appealing to investors. Second, Aeon demonstrates a strong shareholders' return, with a return on equity of 9.18%, exceeding the industry average of 5.25%. This highlights the company's effective use of shareholder funds to generate profits and boosting investor confidence. Finally, Aeon's efficient inventory management is a key strength, with an inventory turnover ratio of 7.13 compared to the industry average of 7.1. This efficiency helps the company reduce overstocking risk, improve cash flow, and maintain operational agility by converting inventory into revenue faster. Strength also comes with some weakness. Aeon Company Berhad faces several challenges that impact its financial performance. First, the company struggles with insufficient short-term liquidity, as evidenced by its current ratio of 0.51, which is far below the industry benchmark of 1.58. This highlights Aeon's difficulty in covering short-term obligations, posing risk during financial strain, and potentially deterring creditors. Second, Aeon has heavy reliance on inventory. With a quick ratio of 0.14, this means that the company depends on inventory to meet financial needs, which is risky because inventory is less liquid and cannot be easily converted to cash during emergencies. Lastly, Aeon's low net profit margin of 2.78% is significantly below the industry average of 6.16%. This points to challenge in managing operational or financing costs effectively, reducing the company's ability to deliver strong shareholders' return and limiting its potential for growth.
Suggestion action to improve the company and shareholder value. First, Aeon company can enhance cash management. It can reduce excess inventory with better forecasting, negotiate extended supplier terms, and can offer yearly payment incentive to boost liquidity. Second, Aeon company can reduce costs, which is it can automate processes, renegotiate vendor contract, and adopt renewable energy to lower expenses and improve profit margins. Third is Aeon company can expand revenue streams, which is diversify with new product, online platform, and subscription service to reach broader markets and reduce reliance on traditional sales.